It wasn't the corporate espionage scandal, the alleged laundering of drug money, or the private banking fraud that brought down Credit Suisse. In the end, it was a 5-word interview response from its biggest investor.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not.
In other words, if Credit Suisse needed propping up financially, it couldn't count on the Saudis. Investors panicked that the bank would collapse and spark a new global crisis. It was the culmination of years of missteps and misconduct that showed what it had failed to learn from the last financial crisis, namely, don't take unnecessary risks with your clients' money. As power brokers, politicians, and executives scrambled to avert catastrophe, the 166-year-old pillar of Swiss finance would be corralled into a deal that almost no one really wanted.
Deal done. UBS will buy Credit Suisse for 3 billion Swiss francs.
Truly historic. This ends a 166-year run for Credit Suisse.
That bell is for the demise of Credit Suisse, the birth of a new bank, and a whole new view on Swiss banking.
It's a bitter pill for Credit Suisse and its investors to swallow. For most of its history, it was bigger and more successful than UBS, a mainstay of Swiss success. The bank's painful and very public demise is a blow to the Alpine nation's reputation for stability, discretion, and reliability.
Historically, Credit Suisse had been seen as one of the banks that built the nation, essentially. They made their star as a way to finance railroads in Switzerland. And from there, it just grows and grows into this economic powerhouse, fueling the nation's economy itself, but also making it a global economy.
It scraped through the global financial crisis without a government bailout, unlike UBS. By 2015, however, signs emerged that it had an unhealthy appetite for what the financial crisis was supposed to have reduced: risk. The acquisition of First Boston in the 1980s had given it a sizable US investment banking presence, but its private banking arm was the initial source of its problems. There was the Geneva employee who dipped into the funds of super-rich clients to cover losses made on other accounts, for instance, and the 2022 conviction for having failed to prevent money laundering by a drugs ring, which Credit Suisse is appealing. As those affairs chipped away at the bank's reputation, the CEO became embroiled in a corporate espionage scandal that would ultimately lead to his departure.
Look, it's been a difficult period, of course, for the bank.
A lieutenant of CEO Tidjane Thiam had hired a surveillance team to watch a former executive who had left to join arch-rival UBS. While there's no indication that Thiam himself knew of any wrongdoing, it made tabloid headlines. While hardly a good look, none of this had any meaningful impact on the company's bottom line. That changed in 2021. In early March, Credit Suisse gets caught up in the insolvency of Greensill Capital, through which it had funneled billions of dollars of loans to less than sound borrowers. But it was nothing compared to what would come barely 2 weeks later.
A sudden multi-billion-dollar liquidation of stocks held by Archegos Capital. This after the little-known firm of former hedge fund manager Bill Wang defaulted on margin loans. While some lenders like Goldman Sachs and Wells Fargo were able to cover their exposure, other banks, including Credit Suisse and Nomura, are said to be facing impairments.
This collapses, and this causes a $5.5 billion loss for the bank. The two events essentially ripped apart the bank at its seams. Every time it came back to a question of what is management doing?
The losses wiped out a year's worth of profit. Thiam's successor as CEO, Thomas Gottstein, had been elevated from running the successful Swiss domestic bank to clean up the firm's reputation. Those efforts were now in tatters. The shares started tumbling and never really recovered. As financial losses widened, Gottstein too was replaced in August 2022, and the bank had its third CEO in as many years, Ulrich Körner.
He had this nickname, allegedly, Uli the Knife, being very kind of cost-cutting focused and very cold, actually, with how to deal with a business in crisis.
Körner starts a turnaround plan. He'll ditch the First Boston investment banking business, and he brings in a major new investor, Saudi National Bank, to back his plan. Even so, the market remains tense.
At this stage, when the bank is so fragile that when a tweet hits just hinting at the potential collapse of a bank, everyone assumes it's Credit Suisse, and that sets off a panic in the markets, the shares, the bonds, and clients panic. A lot of clients decide to remove all of their money from Credit Suisse, and you end up with the quarter finishing with $110 billion worth of assets out the door.
That was almost a third of all deposits. It wasn't exactly a bank run, but it was a massive outflow of capital in the space of just one fiscal quarter. Then March comes.
One stock to watch for all of you. It's SVB. Shares sinking.
This is a classic bank run. And when the bank run starts, you don't want to be the last guy there.
SVB Bank closed by the regulator.
Stocks Europe 600 then being dragged down by the financial services sector, by the banking sector, down by 2.75%.
With banking stocks already depressed by the Californian bank's troubles, on March the 14th, Credit Suisse announced it has found, quote, material weaknesses in its reporting and control structures after questions were raised by US regulators. Kerner tries to stave off investor concern.
So SVB, as you know, is a very recent thing which happened over the weekend and yesterday. So far, it's pretty calm. We even saw material good inflows yesterday still.
One day later, the chairman of Saudi National Bank sits down for an interview with Bloomberg TV at a conference in Riyadh, the Saudi capital.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in.
After the Saudi National Bank chairman's comments, they are just watching their stock go into free fall. And not only that, they're also watching their bonds trade lower.
Axel Lehmann, the Credit Suisse chairman and Kerner's boss, happened to be at the same conference.
So he's rushing back from Riyadh to connect with his management team in Credit Suisse at the headquarters in Zurich Paradeplatz. And they essentially get into a virtual war room to discuss, okay, what are our options? We need to do something about this, because if we let the market continue, our debt's going to go to zero value and our shares are going to go to zero value.
Credit Suisse said early that Thursday it intended to borrow up to $54 billion from the Swiss National Bank. The effort to calm market fears is actually just a gambit to buy time. The regulator has lost patience with the bank and wants to find a buyer. What ensued was deal-making at breakneck speed. When UBS, under duress, finally makes an offer on Sunday morning, it lands like a lead balloon.
Credit Suisse is insulted. They've essentially offered $1 billion allegedly, and that is just a fraction of the market cap that was around $8 billion on Friday, and just peanuts compared to what Credit Suisse was valued at in its heyday.
By the evening, a deal was in place. UBS would pay 3 billion Swiss francs, about $3.3 billion. Controversially, the agreement imposes 16 billion francs of losses on a category of bondholders that is supposed to be paid before shareholders. That might make it harder for banks to raise emergency capital in future, meaning the entire banking sector could still end up paying a price for Credit Suisse's transgressions. With the era of cheap money coming to a close, the global economy in turmoil and investor confidence scarce, the conditions proved too much for a bank that never really learned its lesson from the global financial crisis.